अरे यार, सच बताओ, when it's time to file your taxes and you have to choose between the old regime and the new regime, do you actually calculate it? Or do you just guess, click one and hope for the best? देखो, if you're just guessing, you are voluntarily donating your hard-earned salary to the government. We work all year just to lose thousands in taxes because nobody taught us the basic math. Today, I'm going to make this so simple that you will never have to guess again. You will know exactly which button to click. Okay, real talk. It's March. Your HR sends you that annual email. Please submit your investment declaration by this Friday. And you panic. You open some random tax calculator online, you put in your salary, and it spits out two numbers: old regime, new regime. One's slightly lower. You click that one, done. You feel like a responsible adult. Sound familiar? Here's the thing. That is exactly how most people in this country are filing their taxes. And I'm not judging you. I did the same thing for 2 years. But the problem is that random click, it could be costing you anywhere between 15,000 rupees to 1,50,000 rupees every single year. Not because you're doing something illegal, not because you're missing some secret loophole, but simply because nobody ever sat you down and actually explained how these two regimes work, what the math really looks like, and, most importantly, what kind of person should actually be picking which one. That changes today. I'm Rohan, and I spend way too much time thinking about the psychology of why we make terrible money decisions. If you're someone who earns a salary, files taxes every year, and genuinely has no idea whether you're in the right tax regime or just sort of guessing, make sure you hit that subscribe button and give this video a thumbs up if this helps you out. Because today, I'm going to break down the old versus new tax regime debate in a way that actually makes sense. We're going to do the math, we're going to bust some myths, and by the end, you're going to know exactly, not guess, know which regime is right for your specific situation. Let's go. Alright, first, I need to tell you something that a shocking number of people don't know. As of FY 2023 to 2024, the new tax regime is your default tax regime. You did not opt into it. You did not click I agree. The government just switched you over. If you did nothing, no declaration, no form submission, the income tax department assumed you wanted the new regime. Here's the stat that should actually alarm you. According to government data, only about 30% of Indian salary taxpayers have consciously evaluated both regimes before choosing one. The rest, they either blindly stuck with old habits or got auto-enrolled into the new one. That means crores of people are potentially paying the wrong amount of tax right now, this year. And look, I get it. The tax system in India is genuinely confusing. We had the old Income Tax Act of 1961, a 60-year-old document running our tax lives. And now, from April 1st, 2026, we have an entirely new Income Tax Act of 2025 coming into force. The landscape is changing fast. So let's slow down and actually understand what's on the table. Let me lay out both regimes side by side, and I promise no jargon. The new tax regime, FY 2025 to 2026. Income slab, tax rate. Up to 4 lakh rupees, 0%. 4 lakh rupees to 8 lakh rupees, 5%. 8 lakh rupees to 12 lakh rupees, 10%. 12 lakh rupees to 16 lakh rupees, 15%. 16 lakh rupees to 20 lakh rupees, 20%. 20 lakh rupees to 24 lakh rupees, 25%. Above 24 lakh rupees, 30%. Now here's the headline feature. If your total income is up to 12 lakh rupees, you pay zero tax. This is because of Section 87A, a tax rebate of up to 60,000 rupees that essentially wipes out your tax liability. And if you're a salaried person, you also get a standard deduction of 75,000 rupees, which pushes your effective tax-free limit to 12 lakh 75,000 rupees. Let that sink in. 12 lakh 75,000 rupees, 0 rupees in tax. That's 1 lakh 6,000 rupees per month take home, tax-free. The government literally gave up 1 lakh crore rupees in revenue to make this happen. This is not a small change. The old tax regime. Income slab, tax rate. Up to 2,50,000 rupees, 0%. 2,50,000 rupees to 5 lakh rupees, 5%. 5 lakh rupees to 10 lakh rupees, 20%. Above 10 lakh rupees, 30%. Basic exemption, 2,50,000 rupees. The 87A rebate here only goes up to 12,500 rupees. That means tax is effectively zero, only up to 5 lakh rupees. But, and this is the crucial but, the old regime lets you deduct a ton of stuff from your taxable income before the tax calculation even begins. Things like Section 80C, PPF, ELSS, LIC, EPF, home loan principal up to 1,50,000 rupees. HRA, house rent allowance. Section 80D, health insurance premium up to 25,000 rupees, 50,000 rupees for parents above 60. Home loan interest, Section 24B, up to 2 lakh rupees per year. Standard deduction, 50,000 rupees. Yes, this one exists in old regime too, and so many more. So the question is not which slab rates are lower, the real question is how much can you actually reduce your taxable income using deductions? Let me give you 3 real examples, because this is where it gets really interesting. Example 1. Priya, 8 lakh rupees annual salary, no major deductions. New regime. Gross income 8 lakh rupees. Standard deduction 75,000 rupees. Taxable income 7 lakh 25,000 rupees. Tax 5% on 3 lakh 25,000 rupees, that is 7.25 lakh rupees minus 4 lakh rupees equals 16,250 rupees. Section 87A rebate applies. Total tax equals 0 rupees. Wait, she earns 8 lakhs and pays 0 tax. Yes, that's exactly what happens. Old regime, standard deduction 50,000 rupees to taxable income 7,50,000 rupees. Tax 5% on 2.5 lakh rupees plus 20% on 2.5 lakh rupees equals 12,500 rupees plus 50,000 rupees equals 62,500 rupees. 87A rebate 12,500 rupees, tax payable equals 50,000 rupees plus 4% cess equals 52,000 rupees total. Verdict? For Priya, new regime saves 52,000 rupees. Full stop. Example 2. Vikram, 15 lakh rupees salary, actively invests and has a home loan. Vikram has HRA exemption 2,40,000 rupees, ATC investments 1,50,000 rupees, home loan interest 2 lakh rupees, ATD health insurance 25,000 rupees, standard deduction 50,000 rupees. Old regime, gross 15 lakh rupees, total deductions 2.4 lakh rupees plus 1.5 lakh rupees plus 2 lakh rupees plus 25,000 rupees plus 50,000 rupees equals 6 lakh 65,000 rupees. Taxable income 8 lakh 35,000 rupees. Tax 5% on 2.5 lakh rupees plus 20% on 3.35 lakh rupees equals 12,500 rupees plus 67,000 rupees equals 79,500 rupees. Add 4% cess equals 82,680 rupees. New regime, gross 15 lakh rupees, standard deduction 75,000 rupees, taxable income 14 lakh 25,000 rupees, tax 5% on 4 lakh rupees plus 10% on 4 lakh rupees plus 15% on 2.25 lakh rupees equals 20,000 rupees plus 40,000 rupees plus 33,750 rupees equals 93,750 rupees basic. Add 4% cess equals 97,500 rupees. Verdict? For Vikram, the old regime saves him 14,820 rupees annually. Not massive, but hey, that's a solo trip to Goa every year, or 3 months of SIP. Money is money. Example 3. Shreya, 30 lakh rupees salary, maximum deductions. Shreya is maxing everything out. Old regime deductions total 7.4 lakh rupees. ATC plus HRA plus home loan plus NPS plus ATD plus standard deduction. Old regime taxable income 22 lakh 60,000 rupees. Tax, basic tax equals 4 lakh 90,500 rupees plus 4% cess equals approximately 5 lakh 10,120 rupees. New regime taxable income 29 lakh 25,000 after 75,000 rupees standard deduction. Tax breakdown 20,000 5%, plus 40,000 10%, plus 60,000 15%, plus 80,000 20%, plus 1 lakh 25% on 4 lakh rupees, plus 1 lakh 57,500 rupees 30% on 5.25 lakh rupees equals 4 lakh 57,500 rupees basic. Add 4% cess equals 4,75,800 rupees. Verdict: for Shreya, the new regime actually saves her about 34,320 rupees. Honestly, for someone earning 30 lakhs and maxing out every possible deduction, the old regime still loses here. The gap shrinks compared to lower brackets, but the new regime is mathematically superior even for high earners. Here's what most people don't realize. The decision between old and new regime isn't just mathematical. It's deeply psychological. And I see this pattern constantly. People pick the old regime because they feel like they're being a responsible adult by investing in tax-saving instruments. There's a sense of virtue, like I'm saving, I'm planning, I have an LIC policy. But here's the thing. Saving under compulsion is not the same as wealth creation. A lot of people are locking money into 5-year tax-saving FDs at 6.5% or into traditional LIC plans with 4% effective returns just to claim the 1,50,000 rupees deduction under ATC. Let's do that math quickly. You invest 1,50,000 rupees to save maybe 30 to 45,000 rupees in tax, but the investment itself gives you 4% returns. Compare that to parking the same money in a well-diversified equity mutual fund that historically gives 12 to 14% CAGR. Over 10 years, the difference in actual wealth created is lakhs of rupees, easily 5 to 10 lakh rupees extra in the equity option. You saved on tax, but you lost on wealth. The new regime is essentially saying, we'll tax you slightly more on paper in some cases, but we'll free you from the psychological trap of investing in suboptimal products just to tick a deduction box. That's a really important shift in financial philosophy, and most people are completely missing it. Now you might be thinking, but Rohan, what about my home loan? I've been claiming that interest deduction for years. I can't just abandon that. Totally valid. And if you have a large home loan, say 50 lakh rupees at 8.5% interest, where your annual interest payment in the first few years is close to 4 to 4.5 lakh rupees, yes, absolutely. The old regime makes mathematical sense because Section 24B lets you deduct up to 2 lakh rupees of that interest. But here's a question most people never ask. At what income level does that deduction actually flip the equation? Turns out, the crossover point for most salaried individuals based on typical deduction combinations is somewhere around 15 to 18 lakh rupees annual income with maximum deductions claimed. Below that, new regime is almost always better. Above that, with genuine deductions, the old regime might edge ahead. The key word is might, because you also need to account for whether those tax-seeming investments are actually serving your financial goals or just your tax bill. Okay, but Rohan, what about NPS? That's an extra 50,000 rupees deduction under 80CCD 1B. Surely that helps the old regime. Actually, here's the interesting thing. In the new regime, your employer's NPS contribution under Section 80CCD2 up to 14% of your basic plus DA is still deductible. So if your employer is contributing to NPS for you, you get that benefit even in the new regime. The new regime is not as deduction-free as people think. Alright, let's make this really simple. I'm going to give you a framework right now. Pick the new regime if your annual income is up to 12,75,000 rupees, you pay zero tax. It's a no-brainer. Your income is between 13 to 18 lakh rupees and you don't have a home loan or significant HRA exemption. You hate the paperwork of managing ATC investments and proofs. Your employer contributes to NPS. You still get that deduction. You're early in your career and want flexibility to invest where it makes most sense, not where the tax code forces you. Pick the old regime if you're earning above 15 to 18 lakh rupees and you're maximizing ATC plus home loan interest plus HRA. Your total eligible deductions reliably cross 5 to 6 lakh rupees per year. You already have disciplined investment habits in instruments like PPF, ELSS that you genuinely believe in. You're a senior citizen. The old regime is often better due to no special benefits in the new regime for age-based exemptions. And look, the good news, salaried people can switch every year. If this year the new regime is better, take it. Next year, if you take a home loan and the math changes, switch back. You're not logged in. Note, if you have business income, you can only switch once, so consult a CA. Here's what almost no financial YouTuber is talking about. From April 1st, 2026, India's Income Tax Act of 2025 officially replaces the 1961 Act. This is the biggest structural change to Indian tax law in 65 years. Now, Budget 2026 announced no changes to the tax slabs for FY 2026 to 2027. The existing structure holds, so there's no panic needed there. But the new act is designed to simplify compliance, reduce litigation, and make the tax system more transparent. What this means for you? The government's entire philosophy is moving in one direction: push people toward the new regime, reduce distortions in investment behavior, and create a tax system that doesn't force you to buy insurance products just to save tax. The writing is on the wall. The new regime is the future. The old regime is being maintained, but its attractiveness is being quietly eroded one budget at a time. Does that mean you abandon the old regime right now? No. Do your math every year with your actual numbers. But philosophically, the government is betting that simplicity will win. And honestly, given how most people interact with the tax system, they are probably right. I don't want this to be a video you watch and then do nothing with. So, here's your exact action plan. Step 1. Pull out your last Form 16. Find your actual gross salary and your actual claim deductions. Not what you think you claimed, what's actually on paper. Step 2. Calculate your deductions total. Add standard deduction plus ATC plus HRA exemption plus home loan interest plus ATD plus anything else. If this number is below 3,75,000 rupees, you almost certainly want the new regime. Step 3. Use the government's official income tax calculator on incometax.gov.in. It now has a side-by-side comparison mode. Enter your numbers, see the actual tax difference. Step 4. If you're confused, get a CA. I know this sounds obvious, but a 1-hour consultation with a good CA costs maybe 500 to 2000 rupees and can save you 20,000 to 1,50,000 rupees annually. The ROI on that is literally 10 times to 100 times. Stop being penny wise and pound foolish. Step 5. Tell your HR your choice by the deadline. Most employers need your regime declaration at the start of the financial year in April. If you miss it, they default you to the new regime. So be proactive. Look, I know taxes feel boring. I know this stuff is not as exciting as stock picks or crypto. But here's the truth. Tax planning is one of the only guaranteed returns in your financial life. The market might go up or down, your salary raise might not come through, but if you pick the right tax regime, that saving is locked in every single year. We are talking about potentially 15,000 to 1,50,000 rupees per year completely legally just by making a smarter choice with information you now have. The people around you are not doing this analysis. They are clicking blindly. You now have the framework to do it right. So, do the math this weekend. Don't leave your money on the table. If this video helped you out, please hit that like button. It genuinely helps the channel. And drop in the comments, which regime are you currently on, and after watching this, do you think you need to switch? I read every comment. I'll see you in the next one. Take care of your money because nobody else will.